So what is a broker? A brokerage account is a type of taxable account that you open with a stock brokerage firm. You deposit cash into a brokerage account by linking it with your bank account. Once your account is linked and you deposit cash, you can use this money to acquire stocks. Brokerages charge a flat fee for every buy and sell order, which is why it is always important to research fees and commissions before choosing a brokerage. Different brokerages have different prices and fees. The difference between a cash brokerage account and a margin brokerage account is that a cash brokerage account is an account that requires you to deposit cash in full before you can make any trades. With the cash account, you can only trade the money that you already have deposited. A margin account, on the other hand, allows you to borrow money based on the amount of cash that you have available in your trading account. So when an investor uses margin to buy or sell a position, he pays for them using a combination of his own funds and borrowed money from the brokerage. By using margin, you gain access to about 4 to 6 times the buying power of your account balance. For example, if you start off with $5,000, your buying power can be up to $20,000 to $30,000 because of margin. Even then, margin can be very dangerous and complex. If you lose money using margin, you immediately get a margin call from the broker as soon as the money goes below the minimum requirements. This is called maintenance margin. Different brokers have different rates, but the minimum maintenance margin established by federal law is 25% of the borrowed money. I wouldn't recommend trading margin unless you are truly confident in your trading abilities and develop proven strategies over a period of time. Now that we understand how a broker works, you need to find the right one which fits your trading and investing style and would be a good fit for your starting capital. But before we get into that, it is important to know that there are 2 types of brokers: traditional and online. Traditional brokers are what people used to use before the internet. A traditional broker is an actual person that you can call and tell which stock, how many shares, and what price you would like to buy or sell the stock for. It's a person who will input your order and manage your entire portfolio depending on the type of traditional broker you go to. They may manage your entire portfolio and even make investment decisions on your behalf, depending on what they deem to be profitable, all of which is done manually by the broker. A few decades ago, this is how most people bought and sold stocks. The only way for people to trade was through a professional broker. There wasn't much control or flexibility, and definitely not as many features that we have today. Nowadays, due to the rise of technology and the internet, any person who chooses to invest has the freedom to do so. An online broker is a website or software that we can use to do everything from transferring funds into the account, researching what stocks to buy, putting in the buy and sell orders, and managing everything from A to Z. Some of the reasons why I personally prefer online brokers versus traditional brokers are the following. I have full control over the trading process without any third person involved. Online brokers are almost instant versus traditional brokers who naturally take longer. Fees are almost always higher with traditional brokers because you are using a professional's services instead of doing it yourself. When it comes to the online brokerage, the best way to go is using a software broker. Even though there are websites that you can trade directly from, they are almost always slower with executing a transaction than softwares. Trading softwares are almost always instant versus using a website, which may require you to go through multiple pages before you can put in a trade. When it comes to day trading, the most important factor is speed. A second delay can cost you a lot of money. It's important to remember that the stock market moves very quickly, especially if you're dealing with highly volatile stocks, which is why the faster the speed of the trade, the more money you can make. So even though there are many website-based online brokers, the softwares are the ones we will cover. In my opinion, the best 3 softwares that are good for day trading are Speed Trader, Lightspeed Trader, and SureTrader. We will go over the basic features you need to look for when finding the right brokerage firm that fits your need and starting capital. The way all brokers make money is through charging traders fees and commissions. A commission is what brokers charge per transaction or trade. So they will charge you a flat fee every time you buy or sell a stock. For example, a popular online broker is TradeKing, which charges $5 per trade, while E-Trade charges $10 per trade. The amount of commission you pay is not affected by the number of shares you buy or sell, but instead it's a flat fee per transaction. Traditional brokers can charge you anywhere from $30 to $100 per trade, depending on the company you're using. Some online brokers will charge you per share. Usually, they are a few cents or just a fraction of a few cents per share. There are many important differences between brokers, so make sure to ask plenty of questions about the brokerages with the customer service department. Even though online brokerage accounts offer plenty of tools and features, the possibility of losing internet connection is still out there. So make sure you have a stable internet connection. You should be asking questions like, how can you access your latest transactions? Or, is the brokerage mobile compatible? Can I access a live broker to sell a position at any given time? And other questions that are related. With many brokerages specializing in different areas and so many options, comparing all the possibilities is key to finding the right online brokerage. The most important factor I always look for are trading commissions. These commissions and fees can add up, and if you're not careful, it can add up to a big loss in your overall portfolio. You want to keep the costs down as much as possible, so you can focus on making profit. It is also important to note other fees like direct routing fees, especially for trading, which occurs when you deposit and withdraw money from the account. The second factor, as mentioned earlier, is customer service. 24/7 support is ideal, whether it is live online chat, email, or direct phone call. Having access to quality customer support can really save you from having bad days turn into really, really bad days when a trade isn't properly executed due to the internet connection or speed. The third factor is the trading tools. Online brokerages, which offer a variety of tools on their software, is extremely useful, especially when you have access to live newsfeed and multiple displays of charts. It saves time to have everything in one place with multiple screen setups, which is always beneficial, especially when you dive into technical analysis using advanced charting tools, screeners, to find stocks. Hotkeys also make the trading process much easier. Level 2 quotes is another thing to look for because they provide live bids and asking prices, and option tools to test out trading strategies. These are just a few commonly used tools, but there are plenty more tools offered by online brokerages. Some also offer a free trial so you could get a feel for the software before you start trading. In the next video, we're going to cover the different type of buy and sell orders.